Welcome to the Deep Dive. Today, we're really pulling back the curtain on one of the most fascinating financial transformations happening right now, India's secondary capital markets. We're zeroing in specifically on the pivotal fiscal year of 2024-25. We got a whole stack of sources here, and they reveal something truly remarkable. It's not just about incredible growth. It's more like a deliberate strategic re-engineering of an entire market. So our mission today is to cut through the noise, extract the essential nuggets, and really show you why India isn't just a player, but becoming a real game changer on the global financial stage. Think of this as your shortcut to being genuinely well-informed about a market that's, rapidly redefining itself.
Okay, let's unpack this a bit. By the end of March 2025, India's equity market didn't just grow, it dramatically leapt. It became the fifth largest globally by market cap. Now, what does that really mean for you? It means India is rapidly solidifying its place as a pretty formidable force in global finance. It's a trajectory that, frankly, many didn't predict would happen quite so quickly.
And when you dive into the actual indicators, that expansion, it becomes even clearer. We're talking about a phenomenal rise in investor participation. Just look at the numbers. A staggering 19.2 crore, that's 192 million Demat accounts as of March 31, 2025. These are, those essential digital accounts for holding securities electronically, like a secure vault for your stocks. And the Bombay Stock Exchange, the BSE, alone, it boasted 5,452 listed companies. That's the highest number on a single exchange anywhere. Plus, the equity market's performance has been really robust, showing something like a 10.5% compound annual growth rate over the last 15 years. And get this, domestic institutional investors, DIIs, think India's own mutual funds, pension funds, insurance companies, they poured a record 6 trillion rupees in net investment just during 2024-25.
What really stands out when you look at those numbers is this isn't just accidental growth. It's not random. The core insight here, I think, is this powerful confluence of factors. You've got strong macroeconomic fundamentals, consistent corporate profitability, these rapid advancements in digital financial infrastructure, and, crucially, a series of impactful structural reforms. All these things together are creating this powerful sustained tailwind that's propelling the market forward.
Absolutely. And we shouldn't forget the global context for 2024-25.
Right.
It was an eventful year, to say the least. We saw Indian general elections, the winding down of Japan's yen carry trade, where investors borrowed cheap yen to invest elsewhere. And there was China's economic stimulus and escalation of the Middle East conflict and the U.S. presidential elections looming. Despite all these global uncertainties, India remained remarkably robust. For instance, while the USA's NASDAQ saw a 10.4% decline in the first quarter of 2025, India, despite some early corrections, just kept going strong.
Yeah, and putting that into perspective, India's resilience is particularly noteworthy. Even with significant foreign portfolio investment, FPI, outflows about 1.3 trillion rupees from equity, that's strong participation from the DIIs and individual investors. It effectively counterbalanced those outflows. It really highlights the growing depth and the penetration of the Indian capital markets. We saw mutual fund and individual investor shares reaching all-time highs, 10.4% and 9.5% respectively. That's a powerful statement about the market's growing domestic strength and maybe less reliance on foreign flows.
Okay, so with that incredible growth as a backdrop, how is India's market regulator, SEBI, actually building in more safety and more efficiency for you, the investor? This is where it gets really interesting because they're not just reacting, they seem to be actively innovating. Let's talk about a significant win for investors. Direct payout of securities to client Demat accounts. This is huge, really. Previously, your securities, they were routed through these broker pool accounts, and that carried a significant risk, of misuse. Now, SEBI mandates direct credit straight to your Demat account by the clearing corporation, and fast too, by 3:30 p.m. on T+1 day. That's trade day +1. It significantly mitigates that risk. And if there's one innovation that truly changes the game for individual investors, I think it has to be trading using the UPI block mechanism. When I first read about this, it just struck me as a massive leap forward. Leveraging India's really advanced Unified Payments Interface, or UPI, you can now just block funds in your own bank account for trading, instead of transferring them upfront to your broker. And you even continue to earn interest on these blocked funds.
It provides enhanced protection for your cash collateral and truly reduces risks associated with potential broker misuse.
What's often overlooked about these seemingly small operational changes is their profound systemic impact. It's quite clever, actually. By reducing friction and significantly enhancing trust, these mechanisms actively encourage greater retail investor participation. And fundamentally, they reduce systemic vulnerabilities. It's really about building a safer, more accessible foundation from the ground up.
Right. Another key development is the focus on safer participation of retail investors in algorithmic trading. Algo trading, was traditionally dominated by the big institutional players, wasn't it?
Loosely, yes.
But SEBI has introduced a regulatory framework. There was a circular on February 4th, 2025, outlining specific rights and responsibilities. And this enables safer access for you, the retail investor, to participate in this more sophisticated trading method. And let's look at some other measures for market integrity and efficiency. There's the expansion of the T+0 settlement cycle. T+0 means settlement happens on the same day as the trade. Much faster.
Significantly faster than T+1.
Exactly. This optional cycle is gradually increasing its scope. From the top 25 scrips, now moving towards the top 500 based on market cap. It's involving more stockbrokers, more custodians. This speed is vital for liquidity and risk management. There have also been modifications in call auction duration and a special call auction mechanism. So call auctions are these specific periods where orders are collected and then executed at a single price, right?
Correct. Pre-market or for specific situations.
Okay, so changes were made to the pre-open call auction sessions for IPOs. The random closing now happens in the last 10 minutes of a 45-minute window. Apparently, this prevents that sort of last-minute order stuffing, ensuring fairer price discovery. A level playing field just before the IPO officially opens. Plus, a special call auction, this one with no price bands, was introduced for investment companies and investment holding companies.
Ah, yes. To improve price discovery for those often illiquid stocks, their previous pricing mechanisms could be quite inefficient.
That makes sense.
And the critical takeaway here, I think, is seeing how the regulator is meticulously trying to balance market efficiency and innovation with robust investor protection. It's a constant tightrope walk, isn't it? Especially as market access expands to include more participants and, well, more sophisticated trading methods. This isn't just a standard regulatory update. It feels like a strategic push for healthier market dynamics overall.
So with all these regulatory changes aimed at safety and efficiency, what was the actual market sentiment like during this period? Well, 2024-25 really turned out to be a tale of two halves for the Indian equity markets. We had significant gains in the first half, mostly fueled by strong domestic factors. But that was followed by a period of consolidation in the second half, mainly due to those increased global uncertainties we mentioned. However, despite this, the benchmark indices, Nifty and Sensex, they still posted modest positive returns, which shows remarkable resilience, really. And the surge in trading activity itself was noteworthy. The aggregate turnover in the cash segment, it increased by a whopping 38.3% to 301 trillion rupees. India's market cap also surpassed USD 5 trillion back in May 2024, really solidifying its global position. Geographically, Mumbai still dominates turnover, no surprise there. But it's interesting to see Ahmedabad's share rise notably from about 15.2% to 17.5%. Shows broader participation, perhaps.
Potentially, yes. Or shifts in specific types of trading activity concentration.
Right. Okay, let's transition now to the derivatives markets. They've seen phenomenal growth in India, especially index options trading. I mean, it surged something like 29 times between 2019-20 and 2024-25. That's huge. But there's a crucial flip side to that growth, isn't there?
There is, and it brings us to an important and, frankly, somewhat stark reality. A SEBI study revealed that 9 out of 10 individual investors actually incurred losses while trading in index options between 2018-19 and 2023-24. 9 out of 10. And to put a number on it, 73 lakh individual investors incurred an average net loss of 1.2 lakh rupees in 2023-24 alone. So this clearly highlights a critical investor protection concern in what's become a booming yet clearly high-risk market segment, especially for retail participants.
Okay, so if 9 out of 10 are losing money, that's alarming. What was SEBI's direct response? And what did that mean for market stability? Well, in direct response to these concerns, and specifically to mitigate that excessive speculative activity, particularly around expiry days, SEBI implemented 6 key measures. These kicked in on October 1, 2024. They included things like upfront collection of option premiums, adjusting contract sizes, increasing tail risk coverage, basically measures designed to calm the waters and reduce systemic risk. And as a direct result of these risk containment measures, trading activity in the equity derivative segment did see a decline. The average daily traded value fell by about 20.7% during December to March 2025. So it definitely shows the impact of targeted regulation.
Yes, it really underscores the regulator's commitment to market stability here. Their direct intervention to address these systemic risks, especially the ones associated with that highly concentrated trading on expiry days, it demonstrates a clear willingness to prioritize the health of the market. Even if it means a temporary reduction in trading volumes, it seems like a strategic trade-off they were willing to make for longer-term health.
Okay. Now, shifting gears slightly, let's look at the debt market. To enhance liquidity in corporate bonds, particularly for retail investors. Something called a liquidity window facility was introduced. This basically allows issuers to offer a put option on their debt securities after 1 year from issuance. It provides a kind of structured exit route which can boost investor confidence in holding these assets.
Makes them feel less locked in.
Exactly. And another major success story in the debt market seems to be the request for, quote, platform, the RFQ platform. This is an electronic trading system for various debt securities. Its number of trades has increased approximately 5 times.
Wow, 5 times.
Yeah. Contributing to a 55.4% rise in the total amount traded in 2024-25. It's genuinely helping to revitalize the corporate bond market by shifting from that traditional over-the-counter OTC trading, the direct off-exchange deals, to a more transparent electronic system. Now, here's a really notable shift that occurred in the currency derivatives market. In 2024-25, the total premium turnover just plummeted by a massive 84.8%.
An enormous drop.
Huge. What happened there?
Well, when we connect this to the broader regulatory landscape, the sharp decline is primarily attributed to an RBI notification. It was issued in January 2024 and became effective on May 3rd, 2024. And this directive essentially stipulated that currency derivatives could only be used for hedging purposes, managing existing currency risks. It effectively limited speculative participation, and it caused a significant reduction in the role of proprietary traders, those trading for their own accounts, who previously constituted a predominant, 67.7% share of the market. So consequently, trading activity shifted heavily away from options and towards USD INR futures, which are generally better suited for hedging needs.
Okay, so a direct regulatory intervention driving that massive change. And relatedly, the interest rate derivatives market also experienced a substantial decline in aggregate turnover, falling by 56.6% in 2024-25. We talk a lot about the big market movements and the regulators. But what about the gears and cogs behind the scenes, the essential players that make this whole complex machine run? The various intermediaries and the market infrastructure institutions, the MIIs, they really are the unseen architects of the financial system, aren't they?
Absolutely crucial, the plumbing of the market.
So we're seeing some interesting trends among these intermediaries. While the number of registered stockbrokers actually saw declines in the cash and currency derivative segments at some exchanges, they actually increased in equity, debt, and commodity derivatives. So a bit of a mixed picture there. More broadly, there was a 30% decrease in registered investment advisors, but interestingly, a 17.3% increase in research analysts in 2024-25. Maybe indicating a shift in how investors are seeking guidance.
Possibly. Or maybe just reflecting regulatory registration changes or business model shifts.
Could be. Now, here's a cool new development that directly benefits you, the individual investor.
Yeah.
The Super App for investors. This launched on February 20, 2025. When I learned about this, it immediately struck me as a massive leap forward for just accessibility. This unified app gives you a consolidated view of your securities across both depositories where your electronic shares are actually held. It shows transaction and holding statements, and even lets you monitor your open positions and margin details across different exchanges, all in one place. This truly democratizes information, doesn't it? It extends a facility that was previously mostly available only to institutional investors, now to every retail investor.
Yes, this really illustrates the continuous effort to leverage technology to empower individual investors. Providing them with such comprehensive tools to manage their portfolios and make informed decisions, it's absolutely crucial, especially in a rapidly expanding market where access to information and control is paramount for fair participation.
SEBI also focused on simplifying compliance for investment advisors, IAs, and research analysts, RAs. Some key changes include reducing the minimum qualification needed to just a graduate degree and, surprisingly, eliminating the experience requirement altogether, which makes these professions more accessible, I suppose.
Interesting trade-off there between accessibility and perhaps experience levels.
True. They also allowed for an optional centralized fee collection mechanism, CEFCOM, designed to enhance trust and transparency in how fees are collected. So what does this all mean for the broader regulatory approach, particularly when it comes to unregulated advice? This is a big topic. SEBI has definitely tightened rules to address concerns about unregulated entities and finfluencers potentially misleading investors. New amendments specifically prohibit SEBI-regulated persons and MIIs from having direct or indirect associations with unregistered entities that provide investment advice or make performance claims. There is an important exception, though, for individuals solely engaged in investor education without monetary incentives, so pure knowledge sharing is still okay.
And this, of course, raises that important ongoing question. How can regulators effectively navigate this evolving landscape of digital financial advice? How do you strike that delicate balance between fostering innovation, which is happening rapidly, and robustly protecting investors from potentially harmful or just plain misleading information? It's a complex challenge that requires constant vigilance.
Definitely. And for the market infrastructure institutions, the MIIs themselves, the exchanges, clearing corporations, depositories, there are significant governance changes too. Notably, the automatic imposition of financial penalties on managing directors and chief technology officers for technical glitches, that's been discontinued. Instead, MIIs are now mandated to implement their own internal mechanisms to fix individual responsibility in such cases, aiming for a more nuanced approach, perhaps.
Seems like it. Moving away from a blanket penalty.
And to ensure transparency and accountability, MIIs will now undergo external, independent performance evaluations once every 3 years. Starting from 2024-25, these evaluations will be based on a new set of defined standards and key performance indicators, or KPIs. You can also expect more transparency generally, as MIIs are now required to disclose their shareholding patterns similar to other listed companies, bringing them more in line with broader market expectations.
Wow. Okay, we've truly taken a deep dive into India's secondary capital markets for 2024-25. From its remarkable ascent becoming the fifth largest equity market globally to all these intricate policy changes aimed at enhancing investor protection, market efficiency, and regulatory oversight, it's clear this is a market in constant dynamic motion.
Indeed. What we've really observed is a market that's not just growing in sheer size, though it certainly is. It's also actively maturing through significant responsive reforms. It seems to be adapting quite deftly to both complex global challenges and the rapid adoption of these digital financial technologies. It's a dynamic ecosystem that's constantly refining itself. Absolutely. From those very practical benefits, like direct security payouts and the UPI block mechanism protecting your cash, to SEBI's strategic efforts to balance that explosive growth in derivatives with crucial investor safety measures. It's clear the Indian market is evolving at an incredible pace, and it's directly impacting you, the investor. So thinking back on everything we've discussed, what truly resonated with you from this deep dive? Was it maybe the sheer scale of India becoming the fifth largest equity market? Or perhaps the regulators' direct and, well, stark response to those retail investor losses in derivatives? Or maybe even that new super app giving you unprecedented control over your investments?
And maybe this raises an important question for you, the listener, to consider. As India's financial markets continue to grow and really embrace this digital transformation, what further innovations or regulatory adjustments might be the most impactful, both for ensuring robust market growth and comprehensive investor protection in the coming years? How will they continue to balance those two critical, sometimes competing goals?
Definitely something to mull over as you go about your day. Until next time, stay curious and keep deep diving.